Welcome back to Smart Stock Sam, the channel where we cut through the noise and go straight to what actually matters for your portfolio. Today, we are pulling back the curtain on one of the most polarizing tickers in the AI space right now, Rezolve AI, trading under the symbol RZLV. What we do here is data, and today that data is pointing at something genuinely extraordinary, a company generating more revenue in 90 days than it did in an entire calendar year, while its stock price is somehow heading in the opposite direction. How does that happen? More importantly, what does it mean for you? We are walking through the complete picture today. The revenue bombshell that caught Wall Street off guard, the high-stakes acquisition drama that introduced a cloud of uncertainty, the technical setup that has short sellers sweating, and the analyst price targets that will either look like prophecy or a cruel joke 12 months from now. This is your complete deep dive, the $15 price target versus the reality on the ground. Buckle up, because this one is going to be a ride. Before we get into the granular detail, let me show you the single most important tension driving this entire story. On one side, you have what I am calling bearish friction. In the last 30 days alone, RZLV has shed roughly 14.7% of its share price. That is not a small pullback. That is the market sending a message. But on the other side, the fundamental momentum profile looks almost nothing like a stock that should be declining. We are talking about a full expansion into agentic commerce, a CEO betting his own personal fortune on the company's future, and a short squeeze setup that mathematically is coiled like a spring. Here is the question I want you to hold in your mind throughout today's analysis. What if a company's fundamentals are so strong and its short interest so extreme that the market itself is being forced into a correction? Could we be looking at one of those rare moments where the gap between price and value is wide enough to drive a truck through? Let us find out. As of the May 6th close, RZLV was sitting at $2.37 per share, down about 2.87% on the session, though we saw a slight after-hours recovery to $2.39. What has been driving the recent price action? It comes down to a series of rapid-fire, high-impact events. On April 30th, Rezolve dropped a preliminary earnings figure that genuinely surprised the street. Then came the SQD token integration with a major global fintech partner, followed by a sweeping enterprise partnership with Microsoft. But then things got complicated. Management launched an unsolicited bid to acquire Commerce.com, which many of you know as BigCommerce, and that bid got rejected loudly. Commerce.com's board activated a poison pill shareholder rights plan specifically engineered to block the advance. For RZLV shareholders, this created a deeply uncomfortable double-edged sword. It confirmed that management thinks boldly and plays offense. But it also introduced the kind of open-ended strategic uncertainty that institutional money absolutely hates. The market does not know how to price a hostile takeover battle, so it does what it always does. It sells first and asks questions later. Now let us talk about that revenue bombshell, because the velocity here is the kind of number that stops you mid-sentence. In the full 365 days of fiscal year 2025, Rezolve generated $46.8 million in audited revenue. In just the first 90 days of 2026, they delivered a preliminary $60 million. 90 days, $60 million. They outperformed their entire prior year in a single quarter. This is roughly 17% of their reaffirmed $360 million guidance for the full fiscal year. In any other environment, a revenue print like this triggers an immediate re-rating. So why is the stock at $2.37? That is the exact question we are going to answer. And the answer involves one specific metric that changes the entire valuation conversation. But first, let us talk about how they are scaling this fast, because it does not happen by accident. Rezolve is not simply selling software licenses. They are building a full-stack commerce ecosystem with two massive distribution channels working in parallel. On the consumer side, their SQD token just went live on Revolut, one of the largest fintech platforms on Earth, With over 70 million users globally, that is 70 million potential touchpoints for Rezolve's decentralized commerce layer, essentially overnight. On the enterprise side, they have integrated their proprietary BrainPower model suite directly into Microsoft Azure Foundry, allowing global enterprise brands to deploy Rezolve's AI commerce copilots natively within Microsoft's cloud infrastructure. A fintech channel feeding tens of millions of consumers on one side, the full weight of the Microsoft Azure ecosystem on the other. This dual-threat strategy, decentralized finance for consumers and cloud-backed AI for enterprises, is designed to position Rezolve as the central engine of modern digital commerce. But aggressive growth at this velocity almost always comes with friction, and in Rezolve's case, that friction has a very specific address. The Commerce.com situation tells us a great deal about where management wants this company to go, and at what cost. The unsolicited bid was an attempt to buy their way into a larger market footprint quickly, bypassing the slower and more expensive path of organic growth. The logic is understandable from a strategic standpoint. Acquire a scaled e-commerce platform, plug Rezolve's AI layer directly into an existing merchant base, and accelerate the revenue ramp in a single move. But Commerce.com's board did not see it that way. When they activated the poison pill defense, it was a direct signal that they viewed the offer as inadequate and the approach as unwelcome. For shareholders watching from the outside, this episode created a two-sided coin. On one face, a management team with genuine appetite for scale, willing to make bold, asymmetric bets. On the other, headline risk and strategic distraction at precisely the moment the company needed to be executing cleanly against that $360 million revenue target. The market is currently trying to decide which face to focus on, and until that clarity arrives, the share price stays compressed. The technical picture is telling a story every serious trader needs to hear. The RSI is sitting at 30.8, one bad day away from officially oversold territory, meaning selling pressure has likely exceeded rational justification. The MACD, our momentum indicator, is still bearish at negative 0.05, but it is narrowing, suggesting selling exhaustion may be setting in. Price is pinned at its 5-day neutral zone of $2.37, directly beneath two critical resistance ceilings: the 50-day moving average at $2.52 and the 200-day resistance at $2.64. Both need to be reclaimed for the technical picture to flip. And then there is the elephant in the room, a price-to-sales ratio of 14.0. That is a steep premium for a company still posting net losses, which is precisely why some analysts call this stock overvalued, despite the extraordinary revenue growth. But here is where the story takes an explosive turn. What if there is a mathematical force in this market that has nothing to do with fundamentals or technicals? The short interest on RZLV is currently estimated between 18.64% and a staggering 37% of the free float. Anything above 20% is considered dangerously high for short sellers. Rezolve may be approaching double that threshold. The short borrow fee has been spiking toward nearly 7% annualized, meaning the supply of shares available to bet against is tightening fast. With a days-to-cover ratio of 3.25, any sudden move above the 252 resistance could trigger a forced, cascading covering event. What happens when every short seller tries to exit simultaneously through a narrow door? Prices move violently upward. Could this be one of those setups where the bears get trapped so completely that the stock moves 30, 50, or even 100% in a matter of days? The math says, do not dismiss the possibility. The options market is adding another layer of intelligence that we would be foolish to ignore. There is massive put support concentrated at the $2.50 strike for the May 8th expiration, suggesting that large players are actively pinning the stock near that level into expiration weekend. On the other side, heavy call volume is sitting at the $2 strike, functioning as a psychological and technical floor for the near term. But here is what genuinely commands attention: Significant open interest on calls stretching as far out as $15 per share in the longer-dated contracts. Let that sink in. While short-term traders are engaged in a penny-by-penny trench war around 250, longer-duration institutional money is quietly and deliberately positioning for a potential multi-bagger outcome months down the road. Those are not uninformed speculative lottery tickets. Those are calculated, high-conviction bets placed by sophisticated participants who have done their homework. The options chain does not lie. It tells you exactly where the informed money is pointing, and it is not just the options market sending confidence signals. Look at what the people who know this company best are doing with their own capital. CEO Daniel M. Wagner has purchased 9 million shares through his entity DBLP CCAL Limited so far in 2026, and crucially, these purchases came ahead of a record revenue beat. That is not a token insider purchase made for optics. That is a 9-figure personal conviction trade by the man sitting closest to the numbers. On the institutional side, the picture is split, but clarifying directionally. BlackRock and UBS have both been adding to their positions, while Citadel and Alyeska were the primary sellers in prior months as they reduced their stakes. When a company's own CEO is buying millions of shares at the same time that one of the world's largest asset managers is simultaneously adding to their position, that combination historically signals one thing: the institutional dumping phase may be approaching its final chapter. The analyst consensus is strikingly, almost uniformly bullish. The average price target across the firms covering this name sits at approximately $10.75 per share, representing roughly 350% upside from current levels. Maxim Group leads the pack with a $15 buy rating. H.C. Wainwright is right behind at $12. And even the most conservative voice in the room, Roth MKM, carries a target of $9.50. Not a single analyst covering this stock is pointing anywhere near the 237 we are trading at today. Every single one is pointing toward an eventual return to the 52-week high range. But every disciplined investor asks the same critical question when targets look this attractive: what exactly is the catch? Here is the reality check that separates disciplined investors from hopeful ones. Rezolve exited 2025 with approximately $19.4 million in monthly recurring revenue, implying a $232 million annual run rate. Their stated guidance for 2026 is $360 million. That is not a small gap to bridge. Bridging it requires continued aggressive scaling across both the consumer and enterprise channels, and aggressive scaling at this pace costs real money. The single most critical variable for every investor evaluating RZLV is the dilution question. Can management reach profitability and close that revenue gap without issuing additional shares and diluting existing holders? If they can execute that balancing act, the $15 price target starts to look like a reasonable destination. If they cannot, dilution itself becomes the ceiling on recovery. Watch the share count in every subsequent earnings report like a hawk. It is the single data point that will tell you more than any analyst target. If you are building a position here, two clear tactical paths exist. The accumulation approach means layering in gradually within the $2.31 to $2.35 channel, treating the $2 level as your absolute floor. The momentum approach means waiting for a confirmed high-volume break above the 50-day moving average at 252 before committing capital. That break confirms the bulls have retaken control. Once price clears the pivotal volume shelf at $2.84, the short-term target range of $3 to $4 comes into play. In the 6 to 12-month time frame, the scenario that aligns with analyst consensus is a return to the $8 to $10 range, essentially reclaiming the 52-week high of $8.45. Before my final take, I need to be transparent. Nothing in this video is financial advice. I am not a licensed financial advisor, and I have no knowledge of your individual situation, risk tolerance, or investment goals. Everything discussed today is purely for informational and educational purposes. Always do your own due diligence and consult a qualified financial professional before making any investment decision. Markets carry risk, and smaller cap stocks like RZLV carry amplified risk. Please invest responsibly. Here is the bottom line. Rezolve AI has crossed a genuine threshold. This is no longer a speculative story stock. It is an execution-driven play where the numbers are real and the stakes are high. The bull case is compelling. $60 million in a single quarter, massive insider conviction, a mathematically explosive short squeeze setup, and analyst targets that dwarf the current price. The bear case is equally legitimate, a premium valuation against a backdrop of current losses, an unresolved acquisition battle, and a dilution risk that could cap upside if management cannot scale efficiently. This is a classic asymmetric setup, defined downside near the $2 floor and outsized upside if execution delivers on the promise. Now, here is the question I genuinely want you to answer in the comments. If Rezolve successfully integrates their brainpower model suite across Microsoft Azure while converting even 5% of Revolut's 70 million users into active commerce participants, does the $360 million revenue target start to look conservative? Think about it and drop your take below. I read every single comment. If this breakdown saved you hours of research, hit that like button. It costs you nothing, and it means everything for this channel's reach. Subscribe to Smart Stock Sam and ring that notification bell so you never miss a deep dive like this one. And if you want to directly support the work we put into these analyses, YouTube's Super Thanks feature is right below this video. Every contribution goes straight back into the research, tools, and time that make breakdowns like this possible. Until next time, manage your risk, trust your process, and I will see you in the next one.